Hiring your spouse can create bigger tax deductions. Hiring your spouse for tax benefits, retirement plans, fringe benefits, and bigger deductions. Most business owners think hiring their spouse is about putting them on a payroll, and that's a big mistake. The real tax strategy is not just about wages, it's about retirement plan deductions, defined benefit planning, fringe benefits, home office opportunities, and potentially thousands of dollars in legal tax savings, but only if you structure it correctly. Hi, I'm Craig Cody, I'm a CPA, and we work with agency owners and PR agency owners to legally reduce their taxes, improve cash flow, and keep more of what they make. A little while back, we published the video on hiring your spouse in your business, and that video clearly resonated with a lot of marketing agency and PR agency owners. But it also brought up a bigger issue. Most agency owners understand the basic question, can I hire my spouse and get a tax benefit? But what many agency owners do not realize is that the real opportunity may go much deeper than that. This is not just about putting your spouse on payroll. This is about asking, can this help create larger retirement plan deductions? Can this affect defined benefit plan strategy? Can this open up other legitimate fringe benefits? Can this create a bigger home office deduction? And can this strategy help a profitable agency owner reduce taxes before year end? So today I want to go deeper than the first video. Because if your agency is generating strong agency gross income and your spouse is already helping in the business, this may be worth reviewing before tax season. The big mistake is just put your spouse on a payroll. And this is the advice that most agency owners hear. Pay your spouse from the business, and it sounds simple, but simple is not always strategic. If you just pay your spouse wages, those wages are taxable. They may also be subject to payroll taxes. So in many cases, you are not really reducing the family tax burden. You are just moving income from one side of the tax return to the other. That does not mean that wages are always bad, but sometimes wages are necessary and sometimes they are useful, but wages alone are not the real strategy. The better question is this: what tax benefits can become available because your spouse is now a legitimate employee? And that's where the planning starts. Because once your spouse is a real employee, you may be able to create additional deductions through retirement plans, fringe benefits, and other employee benefit strategies. That's very different from just writing another check. Your spouse must be a real employee. Before we talk about bigger deductions, let's be clear on that. Your spouse cannot be an employee on paper only. They need to do real work in the business. That could be administrative work, like scheduling, bookkeeping support, client follow-ups, marketing support, internal reporting, vendor coordination, operations support. For a marketing or PR agency, maybe your spouse helps organize client reporting, coordinating meetings, reviews receivables, manages documentation, or supports internal systems. The specific role matters less than the fact that it's real. There should be a real job description, and there should be time tracking. The compensation has to be reasonable for the work performed, and the business needs proper records. This is not a loophole. This is a documentation strategy, and documentation matters. Because if the IRS ever asks, the answer cannot be, well, my spouse helps sometimes. That's not a good enough answer. You need to be able to show what they do, when they do it, and why the compensation and benefits are reasonable. Let's talk about the retirement plan deduction opportunity. And let's talk about one of the biggest reasons to consider this strategy: retirement plan deductions. If your spouse is a legitimate employee and your business has the right retirement plan in place, your spouse may be able to contribute to that plan. And that could potentially create another $23,500 or more in deductions. And depending on age, compensation, plan design, and catch-up contribution rules, the number could be much higher. And this is where the strategy starts to get powerful. Because instead of just paying taxable wages, you may be able to pay enough compensation to allow your spouse to make a retirement plan contribution. That money doesn't disappear, it just goes into a retirement account. You may get a deduction today, but you're building wealth outside of the business, and that matters for agency owners because a marketing or PR agency can show strong agency gross income and still create a painful tax problem if planning is not done before year end. The agency may be profitable, the cash may be there, but if you wait until tax filing season, many of the best strategies are already gone. Retirement plan planning has to happen before the deadlines, and spouse employment can sometimes create more room for tax-efficient retirement savings. But this all has to be reviewed carefully, and the plan has to allow it, and your spouse has to qualify, and the wages have to support the contribution. Your business needs to cash flow to fund it, and this is why tax planning and cash flow planning need to work together. A deduction is only useful if this strategy actually fits the business. A defined benefit plan can take this even deeper. This is not right for every business, but for profitable business owners, a defined benefit plan can be one of the most powerful tax deduction tools available. Think of it like an old-style pension plan. Instead of just contributing a set amount like a basic 401k plan, a defined benefit plan is designed to fund a future retirement benefit. And when a spouse employee is involved, the planning can become even more interesting. Depending on age, income, employee census, and plan design, adding a spouse to the overall planning may increase the deductible contribution. In some cases, it can potentially double the deduction. But there's another important point. Depending on the structure of the plan, it may be possible to design a plan so the spouse does not need to be covered. And why does that matter? Because in some situations, not covering the spouse may potentially help exclude up to 40% of employees from certain coverage requirements. This is not a blanket rule, it's not automatic, and it's not something you guess at. It has to be modeled. But this is exactly why business owners should not treat retirement plans like a checkbox. A 401k is not just a 401k. A pension plan is not just a pension plan. The design matters. And for agency owners with 10 to 50 employees, this is especially important. Your employee census matters. Your team ages matter. Compensation levels matter, eligibility rules matter, ownership matters, and profitability matters. So before you assume a defined benefit plan is too expensive, too complicated, or not worth looking at, run the numbers. For the right business owner, this can be a major tax planning opportunity. Let me ask you this. When was the last time someone actually reviewed your retirement plan as a tax strategy? Not just as an employee benefit, not just as something payroll sets up, but as a real tax planning tool. Drop retirement plan in the comments if you want me to do a separate video on defined benefit plans for profitable agency owners. Fringe benefits can create additional deductions. Hiring your spouse may open the door to additional fringe benefits. And not every fringe benefit is worth the effort. But this is where business owners often miss opportunities. Depending on your entity structure, plan documents, and the work your spouse performs, there may be benefits tied to business tools, technology, education, and other legitimate employee benefits. The point is not to push random expenses into the business, because that's not tax planning. That's how people actually get into trouble. The point is to create a real employee benefit structure. For example, if your spouse handles scheduling, reporting, or client communication, or maybe internal administration, there may be business tools or technology that support that role. If there's legitimate training that helps them perform their duties, that may be worth reviewing. And if there are business-related benefits available to employees, those may be part of the conversation. But again, the key is structure. The benefit has to connect to the business, it has to be documented, it has to be reasonable, and it has to fit your entity type. And this is why copying something you heard online is dangerous. A strategy that works for one business may not work for yours. The home office deduction, and this deduction may become very valuable. Another area worth reviewing is the home office deduction. A qualified home office can create deductions when the space is used regularly and exclusively for business. And in some cases, having a spouse employee may create additional planning opportunities. For example, if your spouse performs real work from a qualifying home office space, there may be a way to increase or expand the overall deduction. In some cases, this may potentially double the home office deduction opportunity, but this is just another area where the details matter. The space has to qualify, the use has to be documented, and the work has to be real. This is not about answering emails at the kitchen table. This is not about calling your spare bedroom an office. A legitimate home office requires regular and exclusive business use. If your spouse spouse is doing real work in the business and the work is done from a dedicated qualifying space, then it's worth reviewing. For agency owners, this can matter because a lot of administrative reporting and operational work can happen remotely. But do not assume, document it. Why agency owners need to pay attention. If you own a marketing agency or PR firm, this strategy can be especially relevant. And why, you ask? Because many agency owners have inconsistent tax planning. They may have a strong agency gross income. They may have solid client retainers. They may have a growing team. But if they still wait until tax season to ask, how much do I owe? That's not planning. That's reacting. And by that time, many of the best deductions are already gone. Hiring your spouse is not a magic fix, but it can be one piece of a bigger tax strategy, especially when combined with retirement plan planning, defined benefit plan design, fringe benefit planning, home office documentation, and year-round tax projections. The goal is not to chase deductions. The goal is to build a tax strategy around how your business actually operates, and that's the difference between a tax preparer and a tax planner. A tax preparer records what's happened. A tax planner helps you make better decisions before the year is over. All right, before you go, if you're an agency owner and you want to keep more of what you make, I've got 2 things for you. First, grab a copy of my book, The 12 Biggest Tax Mistakes That Cost Agency Owners Thousands. It breaks down the exact mistakes I see every day and how to avoid them. Second, if you want to see what this looks like for your business, get a free tax analysis. We'll take a look at what you're doing now and show you where you might be overpaying. And if this video helped you, make sure you subscribe so you don't miss future strategies on tax planning, cash flow, and building a more profitable agency. I'll see you in the next video.